Is history repeating itself? Because in 2007, the Fed cut rates by 50 basis points, and we all know what happened next, right? The Fed's recent rate cut has investors on the edge, worried if we are heading for another 2008 style crash. And when they announced the recent rate cut, my mind immediately went back to 2008. But after digging into the data, I found something unexpected. Because the time has come for the Fed to lowering down interest rates in the United States. On September the 18th, 2024, the Fed slashed rates by 50 basis points again, bringing them currently to 4.75 to 5%. So the situation looks similar with 2008, right? The market's reaction was electric. Stocks were doing really great, investors cheered, and major indices hit record highs. The S&P 500 has a record high year to date with 20%. But here's the thing, beneath all that excitement, there is a nagging feeling. Are we missing out on something? Is this the calm before the storm, just like 2007? Here's the challenge. You have probably heard the saying, those who don't learn from history are doomed to repeat itself. But what if learning from history isn't enough? The Fed's recent moves have set off alarm bells for many investors. Hi, I'm Maurice, and I've helped thousands of clients grow their wealth smarter and faster during these volatile markets. And the one thing all these investors had in common is their commitment to simplicity and self-management of their portfolios. So first, let's rewind to 2007. The Fed started slashing rates as the housing market crumbled and the economic indicators flashed warning signs. They cut rates by a whopping 2.75% in less than a year. And in 2008, the Federal Reserve even lowered the Fed funds rate back to 0% to revive the economy during the Great Recession. It did so once again in 2020 to minimize the economic fallout from the COVID-19 crisis. Despite of the rate cuts, the stock market collapsed with the S&P 500 losing nearly half its value by 2009 during the Great Recession. And fast forward to today, and we are seeing some similar moves with the rate cuts. The Fed just cut rates by 50 basis points, aiming to lower borrowing costs as the job market shows signs of weakening. And now you might be thinking, oh no, here we go again. But hold on. Well, there are some striking similarities. The economics landscape today isn't an exact copy of 2007 and 2008. Sure, we are dealing with inflation concerns now, but we need to look at the whole picture. The Fed is now lowering interest rates after having increased them rapidly to tackle inflation. But more importantly, the US unemployment rate is rising, indicating potential challenges in the labor market. This increase should be a sign of slowing the economy, with more individuals struggling to find jobs. Because let's face it, since 2022, the Federal Reserve has started one of the most aggressive rate hike cycles in 40 years. So what's the Fed's game plan here? Are they lowering the rates drastically in the following months? There are experts like Howard Marks who is explaining this rate cut really well.
Rates are likely to be between 2 and 4, not between 0 and 2, the Fed funds rate. And, between 0 and 2 is an emergency measure. And, rates were, the Fed funds rate was 0 much of probably the majority of the time in the 09 to 21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years. Subsidize borrowers and penalize lenders and savers. And I would like to see a Fed get to a neutral position, which is neither stimulative nor restrictive. And I describe that as 2 to 4. If inflation's 2, then the Fed funds rate should be higher than that so that there's a positive real Fed funds rate.
Now, let's talk about those key differences I mentioned earlier. Today's economy isn't a copy of 2007 and 2008 with a global recession or a pandemic like 2020. We've got stronger regulatory frameworks in place and a more diversified economic landscape. So what's the Fed's game plan here? Well, they've got a dual mandate: keep prices stable and maximize employment. When they see signs of economic trouble, they'll lower rates to encourage borrowing and spending. It's their way of giving the economy a shot of adrenaline. It's not just about the cuts themselves, but when and why they happen. But while these differences might change the outcome, they don't guarantee smooth sailing. The market's still riding high and they can make some investors nervous. Are we in a bubble? Is this sustainable? These are the questions keeping investors up at night. But what if these peaks aren't the risky bet you think they are? There is a hidden truth about investing at market high that most people overlook, and it could be the key to unlocking long-term wealth. Let's dive into some eye-opening facts that might just change your entire perspective on market peaks. Because since 1950, the US equity market had set over 1250 all-time highs. That's not a typo, we are talking about an average of more than 60 new peaks every single year. Surprised? Most investors are. We have been conditioned to fear market highs, but the data tells us a different story. Think about it. If you have been waiting for the perfect moment to invest, chances are you have missed out on some serious gains because the S&P 500 has a track record that might shock you. Over any 10-year period, it's ended positive 94% of the time. That's right. Even if you invested at a market peak, history shows us you would likely come out ahead if you stayed in for the long haul. But what about shorter time frames? Well, in any given year, the S&P 500 has a 73% chance of ending positive. Stretch it to 3 years and your odds jump to 84%. Make it 5 years and you are looking at a 88% chance of positive returns. The numbers speak for themselves, right? And you might be thinking, but this time it feels different. But here's the thing, every market peak feels different. There's always a reason to be cautious. But time and time again, the market has proven its resilience. Those who stayed invested through the ups and the downs have reaped the rewards. And as Jack Bogle says, every market decline is very different.
And this last 50% decline, one of I think four I've experienced, was they're all different. That's one really important thing. Don't say I've seen all this before. You never, very few times does the same thing happen twice, and in the financial markets, the same problems happen twice. Yeah, each one is its own. There's some statement like, all happy families are alike, and all unhappy families are different, but all unhappy families are alike in their own way, or something like that. And the problem here is that all these bear markets are very, very different, inspired by different things, sometimes mathematics, sometimes investors' emotions, and sometimes by external factors.
And remember, all those analysts warning against investing at all-time high. Well, the market has a funny way of proving them wrong. It's continued to climb, setting new records and leaving cautious investors to the dust. The fear of investing at market highs can be a costly mistake. So what's the secret to navigating these market peaks? It's simpler than you might think. Invest regularly and keep a long-term perspective. As the data shows, the longer you stay invested, the better your chance of positive outcomes. It's not about timing the market, it's all about time in the market. Think of it this way. Every time you invest, you are buying a ticket for future growth. Sure, there might be some turbulence along the way, but historically the flight has always reached new heights. Don't let the fear of short-term volatility keep you grounded. Now let's take a step back and look at the bigger picture. Throughout this video we've seen how history can guide us, but it doesn't always repeat itself exactly. The Fed's recent moves might remind us of 2008, but the economic landscape has changed. What hasn't changed is the power of long-term investing. Remember, since 1950, the US stock market has hit over 250 times of all-time highs. That's an average of 60 new peaks every year. Scary? Maybe, but it is also an opportunity. The S&P 500 has ended positive 94% of the time over any 10-year period. Those are odds worth considering. So what's the takeaway? Don't let fear of market highs hold you back. History shows that those who stay invested and think long term can come out ahead. But maybe you still are feeling a little bit scared. That's the reason why you need to look into this video, where we discuss the most important topic: a big stock market crash. Do this, says Jack Bogle. What are the most important steps to keep your portfolio safe during volatile markets? See you in the next video.